welcome to Finite Academy. So today our topic is on what is the typical experience of being in the markets or being an investor that have an investment portfolio. So we'll be going through the investment experience from 1929 to 2024. So you can see from the diagram, in August 1929, just before the Great Depression, the index was at an all-time high of 31.68. In November 1929, it declined to 20.3, which is a 35.92% decline. Then it recovered to 24.92 by April 1930, before declining in the next 6 months to 15.06 at December 1930. And then it recovered to 18.13 by February 1931. This period was categorized by sharp declines and small bounce back. So imagine if you were an investor here and you deployed the wrong strategy, which is to buy the dips. Then what you're doing is basically catching the falling knives and cutting yourself as the market bottoms. So how far can the market bottom in a Great Depression? The market bottomed at 4.32 in May 1932, which is a total market decline of 86.36% over a 2-year 10 months period. So imagine if you had 100,000 at the market peak before the Great Depression. By the bottom of the Great Depression, you will only have $13,640 remaining. That will be a huge portfolio loss. And many people then committed suicide because they were unable to come to terms with their losses. That's why it's very important to be clear that the most important in your life is to increase your income earning capabilities. And then having money work for you would be a plus. For if you only invest your excess funds and not rely on them, then they will help to accelerate your wealth accumulation and improve your quality of life. So let's look at the next part. In August 1932, 3 months later from the bottom, it went up to 8.27. The first substantial reverse of above 80% from the bottom. And then basically it corrected and recovered and trended sideways through the next phase of consolidation. From here, you can see that it goes up, goes down, and trended sideways. It is a volatile ride, but you get paid with dividends through the entire ride. And if you buy low, sell high, you would have earned additional capital appreciation. So this basically lasted through to August 1954, where it finally exceeded the August 1929 market prices, which is close to 25 years to go through the market correction and subsequent recovery and trending sideways. So for 25 years, if you buy at the peak, then you would have not made any capital gains, but you will only receive your dividend income. Then this is the macro chart from 1955 all the way to 2000, before the dot-com bubble, where the markets basically went up from 32.1 to 1,500. All this looks like a very smooth ride. In the interim, there were also periods of volatility with marginal returns. So if we narrow into this period of time, between October 1956 to November 1978, the market will have trended sideways, and for 13 years of remaining invested, your capital gains will have been minimal during this period. And most of the money you have made is through dividend payout that you have received. So even though through the 46 years of market going up 46.7 times in value, there is a period of 13 years between 1965 and 1978 where the market trended sideways and you don't make capital gains in that 13 years period. So if you buy when the market is priced highly, then you increase the probability that you have a stretch of time where your portfolio is not making money even after a decade and you are just earning dividend income. So similarly, this is from 2000 dot-com bubble peak at August 2000, where S&P 500 is 1,517. And if you have invested at the peak, basically the next 13 years again, you also don't make money. So what is the lesson here? Do not buy when the stock market is at an all-time high. From the peak of 1,517 at August 2000, it declined 807.45 points over the next 2 years. And then it recovered to 1,551 over the next 7 years by October 2007. Then October 2007 is the peak of the market before the global financial crisis hits. So it is crucial to discern when is the peak of the market, and then make sure you're not exposed to the market then, because you don't want to write the losses down. Or if you are finding a better rate to gauge, then it's best to have a diversified portfolio such that if the market goes and become very expensive, you notch down on equity, and then when the market crashes and becomes cheap, then you notch up on your equity exposure, thus benefiting from the market movements while minimizing your own portfolio risk. So next, from October 2007 to February 2009, the S&P 500 went from 1,551 to 721, a decline of 53.5% over a period of 1.5 years. We call this period the global financial crisis, which stemmed from the subprime mortgages when banks lend money out with easy credit. And then next, from 2009 to 2024, you can see the market is doing well over the last 15 years. So this is the investment journey on a market index of S&P 500, reflective of the 500 largest market cap companies in the United States. You can see that the investment journey is one whereby it goes up over time, but within a decade, if you place your money in at an all-time high, you could see it trend sideways and remain underwater for an extended period of time. And at the same time as the portfolio, if you buy low and sell high, then you have made a lot of money. But most importantly, you must be able to handle the emotional roller coaster while remaining detached from your investment, so they can make the best possible decisions and not be affected by the exuberance that comes along when the market is doing exceptionally well over a period of time. Because that is usually also the worst time to invest. The market is then at its all-time high. You must also be detached from the pessimistic state of the markets when everything is crashing and burning. Only then you can participate to buy when the prices are undervalued. And when the prices are undervalued, then you can buy low to participate in the market upside that comes along in the subsequent market recovery. It can be a very distressing experience if you tie your identity and aspirations closely to how much money you have. So you must have a diversified portfolio of investments across various asset classes to minimize the portfolio volatility, and you must have your portfolio in accordance to your risk profile so that you can hold it over the long term. Even in troubled times, the losses are still within your risk tolerance, and in troubled times to add on to your portfolio so that you can benefit when subsequently the market recovers. Just like the seasons, financial markets also experience cycles and patterns. By understanding the market cycles, you can take advantage and benefit from the market movements to ride the wave up and take cover from the storm. So, if you look at this annual return from 1926 to 2014, you can see that while inflation is 2.9%, treasury bills is 3.5%, long-term government bonds is 5.7%, long-term corporate bonds is 6.1%, large cap stock index is 10.1%, and small cap stock index is 12.2%. So even after accounting for inflation, basically if you invest in T-bills, bonds or stocks, you will have made money on an annualized basis. And thank you for being with us through this investment journey from 1929 to 2024, seeing the ups and downs of the market and understanding what it really means to invest in the market in order to benefit from the investment growth of the underlying companies that you invest in. And thank you for watching this with us at FinUp Academy.